Pepsi stock price was 70. Today it's approximately 65, 66 bucks. Earnings per share, 321. Today, trailing 12 months is approximately 410. The required rate of return, interest rates, in 2008, that 10-year rate plus 300 basis points would give you a 10% required return. Today, it's 2% plus 300 basis points is a 5% required rate of return. If you assume Pepsi's growth rate has come down, and that's very debatable, but for the purposes of this model, I wanted to take it down a little bit. The terminal growth rate in the one case is 4, in the other case is 2. You get an intrinsic value change from $53 to $133. Oh, 2008 it's overvalued, we avoid. 2012, 50 cents on the dollar. Well, if we can buy high quality brands like Pepsi, at 50 cents on the dollar, it changes our whole perspective. That's anybody who wants to play the 50 cents versus dollar game with me, I'll play it with you however long you want to play it. Okay? I give you 50 cents, you give me $1. We've all heard it. Okay? But this is how the numbers work out. So what is the single most important factor? Interest rates. So the question becomes, what do we do as value investors, as the CFO of Pepsi, at CalPERS, major plan sponsors? Well, the CFO of Pepsi has an issue. If I can raise long-term money at 2%, 10-year money at 2%, what should I be doing? Teledyne, Henry Singleton. I should be borrowing money, using my excess free cash flow to buy every piece of stock I can get. Please, when read the Henry Singleton case study. It's well documented. Whitney, can provide it. It's just a wonderful case of history. Is Pepsi going to do this? They have a share repurchase. I can't tell you the magnitude of what they're going to do. Could they go out and borrow $50 billion tomorrow? Yes. Are other companies going to do the same thing? Yes. It's a question of time. Why? Because the CFOs are intelligent. And if their cost of capital is low single digits, it's the only rational thing they can do. Their stock is that cheap. Let's say you're an institutional investor like CalPERS. You're managing $250 billion with interest rates at 2%. Well, you got a problem. What is your discount rate? They just lowered it from 7 3/4 to 7 1/2. Okay? Should you own 30% of your portfolio in bonds? If your discount rate's 7 1/2 and you can only get 2 on the treasuries, maybe you go in corporates and get 3. Do you go to the land of junk? Or should you own no bonds? Be unconventional. That's for John Deere and CalPERS to determine. Okay. We finally got to, you're a value investor. What do? What does Saddlepeak do? Well, for Saddlepeak, it's pretty straightforward. We buy Pepsi and companies like Pepsi. Okay? We do it on a levered basis. We buy in-the-money calls to make sure we get some bang for our buck, because we like 50-cent dollars, but why not put some leverage on it if you can have a high-quality company, Caterpillar, Pepsi, American Express, that are intrinsically cheap. However, if we're going to put leverage on it, what should we do to protect ourselves? Hedge the interest rate risk. How can you do that? There's lots of ETFs out there. There's the futures market. It's a very, very liquid market. All it takes is guts. Because no one can tell you exactly when interest rates are going to turn around. Is it going to be in June or July when Operation Twist stops? Could it be August or September? However, if you buy multi-year call options, maybe you match your assets and liabilities with multi-year interest rate options and or ETFs to match your assets and liabilities, to truly hedge yourself. Then you don't have to predict whether it's going to be in July, which it could be right after Twist, or maybe it's a year from now. All you have to do is be what you should be, a patient value investor. So the question becomes, for a value investor, should we focus on macro events? I really think we have to, because what is the equity markets going to do if interest rates go from 2% to 4.5%? What sort of business effects will that have on certain industries? It could be meaningful. What is the multi-trillion-dollar loss in government securities alone from a move from 1.84 to 4.5? Oh, Doug, don't forget the corporates. Everything prices off the Treasury curve. Pepsi will no longer be able to borrow at 2%. Multi-trillion-dollar losses can occur from the bond market. What does Ben Bernanke and the Federal Reserve governors do if they're sitting on a multi-billion, if not trillion-dollar loss on their portfolio? Let it run off, maybe, so they don't realize the losses. But maybe they won't be able to enact the Bernanke put and buy more. To me, this is a big, big issue. Even though this is a stock conference, just stocks, we have to have a macro overlay. Those are my prepared comments. Why don't I open it up for some